Ray Dalio wrote in an essay overnight about modern monetary theory. He says, I believe we will have to go to monetary policy 3, which is fiscal and monetary policy coordination that is a form that we haven't seen before in our lifetimes. It is inevitable that this shift will happen. Stephanie, what do you think about this?
You know, I give some credit to Ray Dalio because at Milken, which I just came back from last night, there was a lot of talk of this theme of shared prosperity, driving shared prosperity, but actually not a lot of talk about concrete policies, you know, what you might actually do to support the distribution of income or investment in education. And he's actually saying something which I think is true, which is, you know, both from a sort of political standpoint and from an economic standpoint, inevitably we know that the traditional monetary policy tools are not going to be available in the same way when we have the next downturn, because it's not feasible that we're going to have the kind of room to cut by the time we get there that we normally would have. We normally would need, you know, 5 percentage point cut in Fed rates, for example. But there's also this political economy aspect that people don't feel that monetary policy has kind of worked for them. You know, they see quantitative easing and they see it just going into the pockets of banks and bankers, that money, not necessarily into Main Street. So I think he's sort of captured that mood and is perhaps, you know, channeling a little bit of Donald Trump, but with a bit more intellectual rigor.
Ben, Stephanie mentions political economy, and I want to stress the political part of it, because in reading Ray Dalio, I didn't take him as saying this is a good thing or a bad thing. It's just an inevitable thing. It's where we're headed. But one of the consequences of that is if you take it essentially away from monetary policy and the Fed, independent Fed, and you put it in the hands of the politicians, in this case, Congress and the President of the United States, there are some risks involved in that.
I absolutely agree, and I think the bedrock of this whole system is the independence of monetary policy. And so if the suggestion is that we're on a secular trend towards more interdependence between fiscal and monetary, I think there's a limit to how far that can go before the wheels come off. Monetary policy is not the problem in some sense, and it's also not the solution. So it's not the problem in the sense that there are many things driving income inequality and wealth inequality. One of them is quantitative easing. Another is skill-biased technological change. Another is globalization. So we've had these massive trends over the last 30 years that have led up to the difficult political economy driven by inequality. Similarly, monetary policy is probably not the solution for that as well. It's hard for monetary policy to affect structural features of the economy, including inequality. And so at the end of the day, I think policymakers realize that, and I think it's a bit of a dangerous experiment to tinker with the independence of the central bank.